Today, we're talking about a stock that is still down 35% year to date. In a market where stocks only go up, here is a stock that by definition is undervalued. In this video, I'm going to explain why I don't think it should stay that way. Coming up next. Let's do it. What is going on, everybody? My name is Matthew. Welcome back to my channel, and today we are talking about a potential value investing play. Not only is this stock cheap by valuation measures, but it's also relatively cheap, trading at just $11.70 as I'm making this video. And that stock is Dana Incorporated, ticker symbol DAN, or Dan the Man. Give me the format. First, we'll look at who this company is and what they do. Second, a peek at their juicy financials. And then finally, third, why I am considering Dana Incorporated stock, and I'll explain how it's quite literally undervalued. As always, let's get right into it with part one, an overview of this company. Dana Inc., or Dan the Man, was founded all the way back in 1904. They've been around for over 100 years, and during that time, they've made auto parts like transmissions, axles, drive shafts, and sealings with an S for motor vehicles. It makes these parts for light vehicles like your typical car, commercial vehicles like Optimus Prime, and off-highway equipment markets, which includes agricultural, construction, material handling, and mining vehicles like tractors, forklifts, etc. Dana supports what they call propulsion needs for a huge range of auto vehicles, regardless of their fuel source. So whether it's conventional, hybrid, or electric powered, Dana is there to help you out. This month, GM awarded Dana the 2019 Supplier of the Year award for driveline technologies and powertrain cooling. GM went on to say that they recognize Dana's commitment to differentiation through operational excellence and exceptional product technology. This is the third year in a row that Dana has won this award. So that's who they are. Now let's move on to part two, the juicy financials. When things started going downhill back in January, Dana was quick to increase their cash and liquidity, therefore increasing their current and total assets. They had a sharp increase in short-term debt, but that's to be expected given the current situation. And if it weren't for that $308 million increase in short-term debt, their current and total liabilities actually would have decreased from a year ago. With current assets totaling $3.3 billion and current liabilities of $2 billion, Dana has a cool, calm, and collected current ratio of 1.65. Remember, we like that to be above 1 because it indicates good financial health for the next year. And one more thing, they have no significant debt maturities in the next few years, in fact, not until 2024. Which just means that they don't have to pay off much debt for the next few years, which will give them a lot of room to ramp up production again as the economy hopefully recovers and start making that money once more. Let's take a peek at the income statement, shall we? Their net income fell sharply, but again, that is to be expected because a majority of their customers remained idle through the entirety of April, meaning they weren't really producing any orders for Dana. And lastly, their net sales obviously fell from a year ago, but it honestly was not as bad as I was expecting. That's just under an 11% decrease in sales after a quarter that was supposed to be abysmal. Couple that with the fact that automakers are ramping up factories again, and this article is just from about 8 days ago, where demand for cars has been stronger than expected. Many plants are nearly back to production levels since before the pandemic. And one researcher even said people are starting to buy cars now. June sales will still be well below record levels, but, quote, it's all pretty encouraging, end quote. And you might say, well,
Matt, these articles only refer to the light vehicles sector of Dana's customer base. What about all the other people ordering from Dana?
Well, you probably weren't actually thinking that, but if you were, I'm impressed, and that's really just what I was thinking while doing this research. So, this is true, but light vehicles are the sector that accounts for most of Dana's business, and it was also the hardest hit during this whole pandemic, whereas the other ones like off-highway vehicles such as tractors were counted as part of agriculture, which was deemed an essential business, so demand for that kind of product was relatively stable. But the other set of customers that Dana saw struggling during this past quarter were the commercial vehicles, or the Optimus Primes of the world. This demand should also begin to return as the economy seeks recovery, but with commercial vehicles and Dana, I wanted to focus on a different news piece, one that I think all of you will like. Let's talk about it in part 3, why I'm considering Dana stock and why it is undervalued. Dana has a partner that has been on everyone's radar lately, and probably yours too, whether you know it or not. You've probably even watched my video on it, if not a video on it. That's right, Dana is partnered with Hyliion. Success for Hyliion could mean success for Dana's commercial vehicle sector, and believe it or not, the two have actually had a very, very loose connection in stock price lately. So if you like the high-flying, action-packed stock that is Hyliion, or currently still SHLL, then you might want to take a look at the undervalued but boring Dana. They're like a yin and a yang kind of deal. But of course, in the grand scheme of things, this partnership with Hyliion is really just kind of a blip on the radar for Dana because they have so many more massive established customers. I really just brought this point up because it proves that despite being founded over 100 years ago, Dana is still able to change and keep up with the times. But the real reason, the main reason why I'm considering Dana stock is because of a value play. To me, their financials, their product, their road to recovery, it all looks alright. I'm sure their performance could be improved if you smashed that like button. What? But really, there is a mathematical reason why Dana looks undervalued, and is something called the price to book ratio. It is calculated by doing the price per share over the book value per share, and I'll explain this further, don't worry. Book value per share is net assets over the number of shares outstanding, or just the number of shares out there on the market. And net assets is essentially assets minus liabilities. To give you some perspective, stocks typically trade above book value, meaning their price to book ratio would be over 1. This is especially the case with high growth stocks, which are usually way over 1. But value investors like this PB ratio to be under 1. If it's trading under 1, that means it's trading below where it should be. And value investors are all about finding stocks that the market is wrong about. However, anything under a PB ratio of 3 is generally a good value investment. Before you go out there and buy everything with a PB ratio under 1, remember their fundamentals and financials still have to be in good shape. You can't just buy them all. In this case, I think Dana is still in a strong position fundamentally, financially, and I'm done rambling, and hopefully this all made sense, and now it's time to bring it home. Dana has a price to book ratio of about 0.89. Prior to the global shutdown, its PB has been around 1.5. So, by definition, based on the PB ratio alone, this would be a good value play. And whenever I suggest stocks that I am watching, you guys like to comment things like,
well, this analyst says it's going to drop 10% in the next 3 months.
Well, this next point is for you. Dana has an analyst consensus price target of $15, where the highest price target is $22 and the lowest is at $11, which is less than $1 under where it is now. And I know this isn't the most exciting stock out there, but a consensus $15 price target represents a 27% potential upside, while the lowest target of $11 represents only a 6.5% potential downside. So when you weigh a 27% potential upside and a 6.5% potential downside, it's a pretty decent risk-reward situation in my opinion. But of course, always do your own research, due diligence. I am not a financial advisor, just gotta say it. If you found any value in this video at all, please make sure to hit that like button and subscribe, stick around a while, and check out this quote of the day because you might just learn something. Thank you so much for watching to this point in the video. You are the real MVP. Don't forget your peace and thank yous.